Welcome to the Exit Ready podcast. Ryan Ray here as always. Today you're going to love the episode. Be sure to never miss what's going on with the Exit Ready cohort intensive by going to www.rgahub.com/exit ready. That's rgahub.com/exit ready. I'll put a link to this in the description below so you can check it out. But if you're an owner, you're not going to want to miss this. Now, let's get to the show. Well, Charlie, it's great to have you on today. How's it going, man?
Good. How are you?
I am, well, as I told you offline, I'm tired because my sleep was a wreck last night. And I've got this habit to where if I try to go to bed and my mind's on nothing, it's no problem. But if I think about work, my mind just goes and goes. And I can't turn it off. I don't know how to do it. I wish I did because, it's so annoying. So last night my brain was just going over all kinds of this stuff. And so I'm a little dragging today, to be honest with you, but other than that, I'm doing good.
You look
It's a
good.
great.
You look good.
Well, thank you. It's the lighting. It's the lighting. So, give people a quick introduction of who you are and what you do.
Yeah, my name's Charlie Stanton, and I run a valuation firm called Stanton Valuation Advisors, and we value businesses for a wide range of reasons: M&A, gift, estate tax, divorce, ESOPs, and so we value businesses ranging from 500,000 in revenue to $100 million in revenue, and really we're sort of a generalist firm, and so we handle companies from hair salons to construction to IT services to fast-paced tech and startups. So we're kind of all over the board. We can see a lot of different businesses and a lot of really kind of an interesting peek at the economy, to be honest, with the range of businesses we get to see on an annual basis.
Yeah, no, that's the one thing. I like talking to owners in various spaces because you get to hear all these stories, and there's a lot of commonalities, and there's also some differences, right? And so it might be a common problem that you see, but it manifests itself different ways in different industries. So you mentioned ESOPs. So I understand ESOPs, but I'm not an ESOP expert. But for people going ESOP, I've heard of that. What is it? And then what size company can actually qualify to go to an ESOP?
Yeah, that's a good question. So the ESOP is an employee stock ownership plan. It's really great for companies that have there's a feasibility study that needs to be done before you become an ESOP because it is under the ERISA laws for retirement planning. So there's a lot of government oversight over them. Generally, the threshold for a business, you probably want to be at the 25 million or more revenue to be doing it. I've seen less, but you want to have the stability of earnings, probably a more consistent growth, because effectively what it is, it's a way for an owner to exit a business, or at least have a liquidity event for the business without necessarily giving up control of the business and turning the business over to maybe a private equity firm or some other larger group that's going to dismantle the business. So generally what happens is the ESOP, which is almost a separate entity, will go and a lot of times get debt from like a bank, and they'll get the business valued, they'll get debt from a bank, and then they'll use that debt to buy out the owner. Maybe the owner will sell 100% of the business, maybe they'll sell 50% of the business. That'll all be determined. And then every year the ESOP has to be valued, and those shares will can get distributed to the employees. So it almost acts like a public company in that terms, where employees get shares, and then every year there's a valuation done to value those shares, and they have to know that for their own sort of tax planning purposes. And then when those employees go to retire, the ESOP will buy back those shares for them at the value of whenever they retire, hopefully obviously much higher. I've met people who have been at a company where they did an ESOP, and somebody who's maybe been in the company 30 years, they walk away with like $1 million. I mean, it can be a really powerful tool. It can be a really good motivation tool also for businesses, because every year companies will have sort of an update, like an investor meeting. Hey, here's where we are financially. Here's how well we did. The employees have a stake in the business, so they feel much more that ownership level of instead of just being a straight employee where they just get a paycheck. There's that level of ownership that they have. You get a lot of the ESOP numbers. There's a whole ESOP association that will give you the numbers, but there's better employee retention. a lot of times employees are just happier in those sort of instances. And then especially I've seen some of the ESOPs get bought out by a private equity firm. I saw a landscaping business do that a couple of years ago, and all the employees did really well on that deal. So it's for the right company, for the right owner, if that's what you want to do, an ESOP could be a good a good sort of liquidity event for the owner.
I have a little bit of a contrarian take here, and Jackie Hirsch pushed me on it the other day, and that is that more owners should and talk to their key staff at least about what the plan is. And so if ESOP is the plan, or if they're going to sell to PE or strategic or whatever, when they hit a certain goal, and then incentivize that key staff that they're going to get a bonus or an ESOP or whatever it is, so that the key staff, right, the ones that could be tied to your earnout or making sure that you find a premium buyer, they know what they're trying to do and how it helps them, right? Because the owner's going to get a big payday. But if you're the sales manager or the COO or whatever, and you're not really sure what's in it for you to help the owner grow the business, then your incentives aren't aligned. And so an ESOP is one way for that. But there is the question of, do you want to go the ESOP route? And so that's why I was asking about, how big you got to be, because you can't just be, a 500K business and do the ESOP thing. It's not practical. And it doesn't always work out. So do your own research. I've heard some great stories. I got a buddy and he's an ESOP and he loves it. And I've talked to some owners who did it and wish they didn't. And so it's kind of thing. But is that probably the best way if you want to sell to your employees or to key staff? I guess employees in this case, ESOP. Is that the best way for over $5 million? Because under $5 million, you can do like an SBA type route. But over $5 million, is ESOP the best way, or is there other ways that you've seen?
I would say, I think you'd probably want to be higher than ESOP, because ESOP comes with you have to have a trustee, which means that's somebody who's overseeing the ESOP and you have to pay them. And then you have to get the annual valuation. So there's an administrative burden to running an ESOP. So yeah, I would say probably much higher than, I'd say in that 25 million or more range, because you're probably you could be spending $30,000-$40,000 a year just to kind of run the ESOP itself, or more. I've seen some go for even more than that. So you've got to be really careful. I think if you really want a liquidity event, but you don't want to turn over the business, some sort of key management buyout, or go into a bank to get some sort of recapitalization of the cap table to get some sort of dividend to the owner, or might be beneficial. But yeah, I mean, there's an ESOP, you want to be a lot bigger for sure. So I think you're right. Kind of getting back to your point on incentivizing your staff. I mean, there are other ways too, besides an ESOP. There's phantom equity that you can issue. There's that's kind of a key one. You could do stock options technically if you wanted to go that route. That's still burdensome to kind of do, but there are ways to incentivize staff to say, hey, if we hit these certain metrics, we can get there. And that's why sometimes companies too, like, you can do the phantom equity and get those valuations done every year and say, hey, we're going to get a value every year on December 31st. And we're going to see if that value trends higher, and I'll pay you out a bonus if we see that happening. And some companies will do that from time to time. So there are, you can get pretty creative with it.
Yeah. I kind of like the mindset of, okay, here's your flat bonus. This is based upon sales, revenue, margin, stuff like that. Right. And then let's just pick some numbers here. So come to someone like you said, the company's worth $10 million. Okay, so, we're doing this much profit margin, we figure that out. Okay, here's how your bonuses work. I want to exit at 15 million. Okay, so if we get to 15 million, then you're going to get this type of bonus, and maybe 13 this or 12 this or whatever it is. But then it allows them to understand that you may not exit for 20 years. It might be 20 years. And so they have these current bonuses that are in place. But as they go up, if that day comes and you come to them and say, yep, we're going to go to market, they now know what was on it for them, and they've known this whole time to help you grow that. And so I think it's a way, as you mentioned, there's a few options there. I'm not sure you should actually give actual stock to the employees, because that can cause a lot of problems. But you can tie the bonuses there, and if you do it right, you can tie those bonuses time delayed so that they stay 6 months or a year with the new owner. So therefore, all of a sudden, the new owner is incentivized to pay them well, keep them, retain them, and happy that they've bought a company with great talent coming to them as well. So I think that more owners what I've seen is so many owners are so afraid to talk to their employees because they're afraid they're going to leave. It's like, well, if you talk to them earlier and your culture was this, like this is part of who we are. We're not saying we're going to go to market tomorrow. We're saying once we get to here, we're going to go to market. And as you know, just because you go to market for a current valuation, things change, right? People balk at this stuff, and so having that mentality of just kind of an openness and people knowing, and maybe it's not the whole company, maybe it's 20% or whatever it is. They kind of know where things are at, where it's going. It gives them a perspective of what you're going to do. So whether it's ESOP or strategic or PE or whatever it might be. There's a lot of ways to do that, but too many owners I've seen, they're way too hesitant, and then it gets to the very end, and they're hoping that staff is going to stay with new buyer, and it's like, man, that's risky. That's risky. And now, I guess on bigger deals, you see probably a little bit different, but on smaller deals, that seems to be the case.
Yeah. I would agree with that. I think one thing ESOPs do a good job is they incentivize everybody. It kind of brings the focus in like, hey, we all are really marching in the same direction, right? Whereas if you don't have those incentive programs, it's really hard to say, well, what directions everyone, am I just going for my next quarterly bonus where the owner is like, I'm 10 years out here thinking, not, I don't necessarily care what happens next quarter. I want to know what happens. What are we doing today to build the foundation? So, there are lots of incentive ideas that you could do that can help people, kind of see that longer term. So I think if you're an owner and you're right, your staff isn't there, you want them to think longer term, well, you got to incentivize them at that longer term, with a promise of a payout. And again, some of that like phantom equity, it's still written in an agreement. It's contractually obligated, but it's not straight equity to the staff member. It is saying if we, you're at a base level of 5 million and we get to 10 million, I'll give you a 5% of that growth, and so you get that sort of stock appreciation where it's not so much, but you have true. So that employee leaves, that contract gets canceled.
Yeah, and as always, talk to an attorney. This is just a podcast, entertainment only. Exactly. Talk to an attorney. Exactly. Gotta say that these days. It's crazy. Okay, so an owner calls you right now and they say, I want a valuation on my business. How long does it take to get that done?
Yeah, great. So someone calls me today. It can take me as quick as a week. It can take longer. It's dependent on how quickly I can get information from the owner. It's a 5-step process. We first define the scope of what's the valuation for. Why are we doing this? For instance, is this M&A? Is this an estate tax? Is this a gift? Are you gifting shares of a business to a child or somebody, or a trust or something? And then we'll define the scope. We'll gather the information that I need. I mean, valuing a business like peeling back an onion. I mean, just layer by layer, you uncover one layer, find out there's another layer of information that you need. But we try to be pretty strategic about what questions we ask, especially, when we know the business, the industry, we know kind of the heart of the metrics and information we need, but we do ask for a lot. Then we'll analyze the information, send a draft report to the client, review the numbers, and then we'll send a final. So it's a pretty streamlined process. It takes, usually about a week to about 4 weeks. I will say the thing that takes the longest is sometimes just getting information from the client. Sometimes they may have to, I like to look for some appraisers. Hey, maybe just give me the last 3 years. I like to look 5-7 years, really kind of see some trends, see some of the patterns happening in the business over longer periods of time. And so it can be done quickly, and especially M&A transactions, we can work very quickly. I've done that. I mean, we had one where the guy called me on a Monday, and by Friday he had the report, and I think then it took him like 3 months to, I think, finally close the deal. But we got what he needed there, so he could have that negotiation.
Okay, and so then the question might be okay, an appraisal, great, but is this like a mortgage appraisal on a house? Like, can I tell the buyer you got to pay this price? Is like negotiation like, okay, I got an appraisal, but what does that actually mean?
Right. Well, I think what gets missed a lot, people don't understand, is appraisers look at a business through multiple lenses. So there are, we call them standards of value. And so the bigger takeaway is that one business could have many different values. I think that's sometimes hard for people to digest. But If you're getting an appraisal done for the IRS, you have to look at it through fair market value. It's a hypothetical situation. Now that's going to just come to a different value than what we have under a strategic appraisal, which would be, hey, company, my competitor down the street just offered me X dollars for my business, right? Well, they're looking at it from a strategic point of view. Maybe they can cut out 30% of your staff because they already have that staff. And now the cash flows just kicked up for them and they're willing to pay a much higher multiple. They're financial buyers in the market, right? They're going to be looking at more return on their investment. They may pay less than a strategic acquirer. So we will look at it from a fair market value. We'll sometimes have to look at a business from fair value, which has a definition that's mainly more for financial reporting purposes. And then we'll also look at them through mainly like some sort of investment strategic value. So, I say that because sometimes people get a valuation done for an IRS reason and then go, oh, I think I can sell it for a lot more. Well, maybe you can sell it to the right person, to the right buyer, but under fair market value, we're looking at a hypothetical. We're basically satisfying what the IRS is going to require because that's the trier of fact. And that's really what kind of gets back to in a lot of these. It's like, who is the trier of fact in that valuation? Is it going to be the IRS? Is it going to be, a buyer? Because a lot of people, I'll do a lot of valuations where it's like, hey, I've been running this for like 15 years and I just don't know what it's worth. So I'll tell the client, yeah, let's do it under fair market value. Let's just kind of see what a hypothetical buyer would pay for your business. We'll look at market transactions. We'll look at the cash flow. We'll value it. Now, this doesn't mean you can't get more out of the business. And it doesn't mean necessarily that a buyer will pay, necessarily that market value. So there is some range there. A lot of times too, in those instances, I'll try to give people like a range of values. So, it's maybe going to trade between $1 million and $1.2 million. It's kind of where that price lands at, because it is hard. If you find the right strategic buyer, they may pay a premium for your business because they might knock out a competitor in their industry, and that's highly valuable to them. Other people are like, hey, I just want to buy a business. I'm tired of my job and I need to make a certain amount of money and I want to get a good return on my investment. Well, they're going to pay a different price than what your competitor or strategic person's going to pay for. And then for the IRS or divorce cases, those follow fair market value. So they're just going to be valued a little, typically a little differently than what a strategic acquirer would maybe pay for something.
Hey, quick break here. If you're an owner, do you know that most companies will never actually sell? That means that all those years that you put into building your business are for nothing. If you want to build a business that's valuable, that people will want to buy, and you could make potentially millions of dollars from, go to rjhub.com or click in the link below. That's rjhub.com or click on the link below. And now back to the episode. And I think that's a good point there, is that when you talk about the range of valuation, if a strategic is coming after you because they're trying to, like if in oil and gas industry, I used to work in a lot, strategics would buy smaller companies because of these things called MSAs. And company A might not be able to get an MSA with this, I'll say ExxonMobil, whoever it is, but company B has that MSA. Well, company A could be really huge, but they can't get in with ExxonMobil, but they could do a gazillion dollars with ExxonMobil, but company B is not that big. But by buying them, they get that MSA and get access to ExxonMobil. And so all of a sudden the valuation of the company is completely off the charts compared to what it would be if, a searcher or some, normal buyer comes to buy, because this huge company is going to be able to do, $100, $200, $300, $400 million with ExxonMobil because they could do that. But for whatever reason, they couldn't get that MSA. And it sounds weird, but in the oil and gas industry, you see stuff like that. But that's the exception to the rule. And that's the key part. Like, that's the exception to the rule. You have to have this special circumstance where there's these contracts, they only come open so long, and those MSAs don't even guarantee work. And so you have to have all these special circumstances. So you can see strategics coming in there, but I think owners hear that, go, oh, I want to sell to a strategic, but you have to find yourself in a spot to where you are being eliminated potentially or being absorbed. But if they're going to do that, also you have to have some kind of special asset or some kind of special thing that makes this strategic want to eliminate you, right? Or want to acquire you or want to absorb you. Because if you're just average Joe in Hood County, Texas, and it's like, oh well, you don't have anything special about you. I think people kind of miss that those crazy premiums you hear sometimes from those strategics are really tied to something special about the company or the
Yeah.
industry that's unique. And people hear, they go, oh, that's what I want. It's like, yeah, everyone wants that, but it's really hard to
Yeah.
find the industry and the opportunity and then the strategic to come to get you.
And I think, that's the biggest issue I come across. I was valuing a pest control company, and the owner was like, oh, I'm reading all these trade publications that people are getting bought out for 15, 20 times EBITDA. And so what happens is owners hear those numbers, that maybe at a cocktail party, maybe at a trade show, maybe in some industry publication, or maybe some, website that they follow. And then they don't realize that they don't, I'm like, all right, you need to know more information. What's the revenue size? What market are they in? Where, do they have a different sort of pricing structure than you? What are they doing? And then they don't know. And so they want to take that information and sort of extrapolate it into their business. Say, well, can we trade it at 15 times? And I'm like, I'll then go pull up market transactions that I have access to and say, look, you're maybe trading it, 6 times right now based on your revenue. If you can get to double your revenue, maybe you go to 8 times. I'm not seeing anywhere in the data, that you're trading at that. We'll value the cash flows. Can that imply a market value that high? Maybe, maybe not. So I think it is one of those things. Like, I think you have a great point. It's like you have to find that strategic acquirer. Who is that? You have to identify them. You need to build a relationship with them, and you need to have something unique about you that they want to buy. I mean, are you the biggest player in your city or your space or whatever? Is there some dynamic that they're going to want to tap into? And I think a lot of owners will get really excited, but the reality is, it's like you're just sort of sometimes you're just an average player in your market, or maybe you're kind of the top 5 of your market, but that doesn't mean a strategic's going to come in. They might want to get the top 3 out, and then by the time they get to you, they're hoping to beat you down through pricing and all this other competitive forces that they can either eliminate you on your own or buy you out cheaper. So I
Yeah.
think people have to be really kind of cautious about what they read about, because unless the cash flows, unless the numbers really can support that, finding those strategics can just be really challenging. Now, on the other side, I am working with one group. These guys know what they're doing. They are in a very niche business, and they do repossession of like ATV vehicles, and they're like
Hmm.
one of the only guys that do it. And they are very good at it too. I mean, they are like the top, and they're doing exactly that. They came to me and said, well, what's this thing worth? We want to get to this multiple. We have relationships, and we know exactly who our acquirer is going to be. It's like 3
Hmm.
companies we know, and we're developing relationships with them. We're letting them know what we're doing. And then we kind of work through the numbers. Can we get there? What do we need to do financially to make sure we can achieve the multiple we want to get? So it takes a lot of work. These guys aren't just hoping that acquirer calls them up one day and sees them, identifies them in the market. They're actively pursuing that. And that's, I think, kind of to your point earlier, is that you have to really take that stance to really get there. And they're checking off all the
Yeah.
boxes. They're the best.
Yeah.
Huge amount of profit, growing well, no key person reliance whatsoever, no customer concentration. It's like all those, they check all those boxes off, and
Right.
that's what the buyer's going to want to see.
Yeah. And I would say I don't know what your opinion is. I would say for 99% of companies, what you just described and what we're just talking about is not even relevant, right? And so you
Mhm.
like to really go after that strategic and get that crazy payday. It's really, really hard. Most people are going to trade for the average multiple, but they're trying to get the top end of that average multiple in their industry by trying, if they're smart, by trying to be a premium company, customer concentration, owner dependency. They can fix those things and then get the high end of that range in their industry. That's really what you should be shooting for if you're trying to be exit ready. But it seems that owners think, oh well, I'm gonna go above that and get this crazy strategic PE valuation that's over the top, and that's really hard. But to kind of get the top end of the range, and I kind of joke that people say, well, what's my company worth? I say, well, 3 to 7 times EBITDA. It's kind of always
Right,
my
right,
joke,
right.
right?
Well, that's the
It's,
range right
that's
there,
the
pretty
range.
much.
They're like, that's a big range. I'm like, yeah, I know, I know.
Yeah.
But
I
that's
know.
that's the truth, right? And
That's
so
it is
and
the
so your
truth.
goal, if you just took that, you heard us say that, and you go, well, okay, get someone to figure out your EBITDA. I always tell owners, get someone who knows how to do it. I've only talked to a handful of owners that have ever actually got it right. And I'm not an EBITDA guru. I'm not. Don't call me. Call you. To get the EBITDA done. Get your CPA. Get someone to do it for you. Um, but then take that and multiply it times 3 to 7 and go, okay, that's the range. And then what are the things that get you closer to the 7 and the things that get you closer to a 3?
Hmm. Yeah, and I think that's where. So I always advise owners, if you want to sell your business one day, at least 5 years out, get a valuation done. And I'm not trying to talk my own business here, but I will. And because what we do when we do evaluation is we identify operational risks in your business, again, key person dependence, revenue concentration. We're asking, do you have SOPs in place, or is the whole place just a madhouse that everyone's running around, or the one employee's been with you for 20 years, they know everything about how the business runs, and the rest of the business can't function. So we want to identify operational issues. Then we want to identify financial issues. We compare your business to industry peers. How does your profitability compare? How does your leverage compare? Are you utilizing capital? Is there excess capital? Are you undercapitalized? So we'll try to identify all that, let you know where we see risks in your business, and then if we can, advise on ways to get out of that. Like I valued an electrical contracting business. This guy had built out this incredible operation. He would prefab everything. So when he showed up on install date, he was done like 3 times quicker than any of his competitors. His contractors loved him. Problem is that it took him like 70 days on average to collect his receivables when the industry average is like 40 days. So it's like, yeah, you're doing everything right, but you're like missing out on like hundreds of thousands of dollars a year in cash flow just because your contractors, even though you're doing the right steps, they're not valuing what you're doing, and that value is now hurting the value of your business. And yeah, you'll get the money, but now that money's coming in a way slower than what you would have been reporting year over year over year. So, we want to identify issues like that, see how you compare areas you can improve. And then the reason I say at least 5 years out, because it takes years sometimes to correct these issues. If you've got key person risk, you need to go hire somebody, you need to train them, you maybe need to help get a replacement if you plan on selling to some sort of third party group who's not going to want to take they're not going to have the staff to just take over your role specifically as the owner. So we do all that, then value it, and so then you have a range, because the valuation also determines who's going to buy. I mean, if your business is worth 500 grand, you're just not necessarily going to be in the PE realm. If it's worth 100 million, yeah, your managers aren't going to probably be able to buy you out at the $100 million valuation. So knowing that value is going to determine what sort of buyer pool you're now going to be in.
Yeah, no, it's one of the things, and I got to come up with a good analogy because I don't know how else to describe it, but um, I think owners, and I always say this, I'm not being disparaging to owners, as I'm not an expert in what they do, right? That's not my thing. I don't know how to run a roofing company or construction or
Right.
electrician. That's not my thing. When they come into this world, though, their knowledge is not what it needs to be to get the premium value. And their expectation is they want a premium value. It's like, well, no, you got to do these things to get the premium value. Just as you mentioned, the guy who was doing this stuff really fast. That's great, but then your cash collected is lagging behind. And you might, for him, it's fine. He's got great relationships, good business, making a good living. It doesn't really matter if it's 75 days or whatever you said. It doesn't matter. But for the buyer, it matters a lot. It's like, oh, we want to fix it. And so owners don't see that, oh, I need to fix this, and I probably can fix this. And so, yeah, and you mentioned key man risk. Now, the biggest key man risk, I think, is the owner. For a lot of these companies, they get to 100 million. Okay, it's probably a little bit different, but I tell the story a lot. I talked to an owner one time, 30 million a year in revenue, and he told me, well, if I go away, the company closes its doors. I'm like, well,
Yeah.
okay, because he had all the relationships. They all called him. He put the crews out. It's like, Uh, he's talking about selling to his sons, and I'm like, well, if you die, what are your sons going to do? Like, if you're serious in saying that if you go away, this is over, then that's a huge risk for your sons or a third party buyer or whoever. And I get the sense of pride that you've built this
Hmm.
thing up, but from a buyer's perspective, you go, wait, what am I buying then? I'm not buying a
Yeah.
company. I'm not paying for anything. I'm paying for you to hopefully live, because I don't know, you might get hit by a truck the day after closing, even though you rust down and consult for a couple of years. You might hate me. And I think a lot of owners, they take pride in the fact that the business they built is about them, but
Yeah.
actually there's more pride in saying that my business is more valuable because it's not about me. And it sounds counterintuitive, but that's actually the thing to be proud of. Like my company, if you're trying to sell, if you want to do lifestyle business, then ignore all this. But if you want to
Mhm.
sell, the real thing to take pride in is that your company doesn't need you anymore. Because that's where it becomes more valuable.
Yeah, I think that's exactly right. I've started to really understand the process that a lot of those conversations. It's like there's value of your business, right? And a good example is like a law, like an attorney who's practicing on their own. All the relationships, all that is goodwill, right, with them, and it's very hard to transfer. And now you start seeing these owners who you have to explain to them that you don't have you have value, right? Maybe you're doing $1 million a year in cash flow, and you're just raking it in, but all those relationships are with you, and you're right. The minute you step away, the entire business shuts down. Your customers stop coming to you because the only reason they're picking up the phone is because of you. And so what we identify is that, try to have that conversation that yes, there's a lot of value here, but most of it is personal goodwill or non-transferable value. And we need to get it from the non-transferable to the transferable, because all the buyer's ever going to look at is what can actually be transferred over to me. And I think it does get back to a lot of businesses have been so prideful in what they built and so proud of it. And I think a lot of them like it. It's great when your customer calls, "Hey, I want to buy from you. Hey, I want to get this from you." That's awesome. But that's not a sustainable, transferable business if that's what you want to build. And I think a lot of people find that out a little too late at times when they go, "Well, no, this is really well. It's supported my family and my kids and whatever and blah, blah, blah." But yeah, you're not doing the right steps to actually make it so people are calling, John or whoever. And I think sometimes, a lot of times businesses are built by, people who are, sort of a type A characteristic, right? They're aggressive. They're going to go out. They want to have that control, and then it's kind of they have to actually give up that control. And I think that gets kind of hard, and that really actually just impedes on the value that they're going to actually ultimately get for the business.
Yeah, and again, this is key. If you want to sell your company, you're going to exit.
Yeah.
That's what I tell every owner. You're going to exit. It's either you're going to close your doors, you're going to die, you're going to be forced to sell. You're going to exit. That's not an option. How you exit is the question. And what you're trying to work towards. Of course, you could die prematurely, and all this goes out the window. But what are you
Right.
trying to build towards? And if you said, no, I never want to sell this thing. I make a great living, and I don't want to go and do the stuff you're talking about. Great. Just understand that the last year, if you change your mind, you can't say,
Yeah.
"Oh, now I want to sell it." It's too late, right?
Yeah.
And so just
Exactly.
plan for that accordingly. And if you want to sell, you said 5 years, and I think that's you said, "Well, I'm not trying to talk my own book here," and I think it's not trying to talk. I don't know if okay. First off, hire Charlie. But so I'll talk your book for you. But I do think that so many owners. I have a client right now, and he's getting ready to go to market with a firm we work with, and he's ready to sell. And the range is around that $10 million range, and customer concentration is going to be a big issue on his deal. And if you'd fix that, it'd be probably worth 15, 17 million. But he's just ready to be done, and so he doesn't want to fix it. And so hopefully customer concentration doesn't drop it below what he would go to market for or he would sell for, but it could. You know how these things go.
Mm-hmm.
It's going to be a sticking point. It's a great customer. It's a great. I mean, it's something that if you told someone this is the numbers, they'd go, "Oh wow." But then you say, "Well, write me a check for $10 million to inherit this." Like, oh, okay, I don't know about that, right? So it's a problem.
Right.
If you have it, you like it, but to pay $10 million for it, we'll see. We'll see. Maybe a
Yeah.
larger strategic will or whatnot. But But a lot of owners don't think that way, and they get to this point till they want to exit. Like, oh, okay, yeah, I need to go to market. It's like, well, these are the things. So when you said 5 years, because in his case, the advice he was given was, well, if you fix some of these issues, you can make 15, maybe $20 million, but you got to fix them, and that could take, let's say, 6 to 8 months for him to fix them because of connections and stuff like that. Great, but then the proof of revenue
Yeah,
that you actually have fixed it
exactly.
has to be like a year and a half, maybe 2 years. So you're talking about maybe 2 or 3 years plus the M&A process is 6, 9, 12 months. You're talking about 3 to 4 years of fixing this issue to get that money that he's hoping to get. And so when you talk about get the valuation today, it is important because you go, well, maybe I don't want to sell in 5 years. Okay, great. But at least understanding how far away or how close you are to your goal is really important, because then you can start setting goals and slowly work towards them. Because if you have a company, and from a valuation standpoint, I'd love to hear how you handle this. If you had a company that's doing, let's say, $10 million a year, and they go out and they sign, Bob Smith Contracting Company, and Bob Smith Contracting Company pays them $5 million. So they got $15 million for 2026, but there's no reoccurring, there's no contractual obligation to keep going. So they went from a $10 million a year to a $15 million a year the next year, but there's no guarantee that Bob's coming back. How does that look from a valuation standpoint?
Yeah, I mean that's where I'm actually dealing with that exact issue. I'm a home builder right now. They do the framing for houses. They went from 15 million to about 50 million during COVID in revenue. Now the entire market has changed for them, and it's going to now drop their. So last year I think they did about 30. This or 2025 they're about 30. They're now forecasting like 10 million next year. And it's because it went from this we'll pay anything to get a house built from the builders to the builders now say we need discounts. We're going to go find our own suppliers. We only want you to bring the labor. We're not going to pay you to do anything else. And the entire industry, as the client kind of puts it, has been reset. And that, yeah, from a valuation standpoint, if you look back at the last 5 years, I mean, the owner had pulled out 20 something $1 million out of that business in distributions. Going forward, you'll be lucky if maybe you're going to get 500 grand out of the business next year. And so, from a valuation standpoint, which is real critical, why you don't want to just rely on like rules of thumb or, some sort of software, because what's happening is we have to forecast the next, till that business they think can stabilize, which could be, they're thinking they're probably not going to stabilize and get back to norm and for like another 3 or 4 years. So we've modeled that out to say, here's what we think the next 3 or 4 years look like, because it's definitely not what you guys have seen the last 5 years. And it's not even the 5 years before COVID that they think. Like, they think the entire industry has been reset. And that is that happens a lot, especially with the COVID area. Everything just got really wonky there for a while. Some businesses did extraordinary, some did really bad. And then they've all seemed to kind of right size in the last, at least 2025. But yeah, it's having the understanding that we have to go and forecast going forward, make some assumptions, because that, business is all forward looking. And the multiples that we saw during the last 5 years, I don't think they're going to apply, because I think margins are going to come down. I think revenue is going to come down. So what we saw and what, the kind of the good old times for this business, it is changing. And you just have to really model that out kind of going forward. So I think that's really key to kind of, in any of those wonky situations, you really have to then sit down and actually put together some sort of forecast. And a lot of people, they don't like to do forecasts. They're like, I don't know the future. Nobody knows the future. I don't know what's going to happen even tomorrow. We all recognize that, but we have to start making assumptions about what we think is going to happen. And we have to model it out until we get to a point where we think it's going to sort of normalize. And then that could be 5, 6, 7, 8 years. A lot of people think, oh, I'll just do a 5-year forecast and call it a day. Well, you really should model out until you think it's going to normalize. That could be I'm working at a hair salon right now. We're going to do a forecast for 2 years, because they're doing a bunch of work, and then that's going to sort of stabilize in about 2 years. But other businesses might take 6 or 7 years to really think through and go through those scenarios of what maybe will happen over that period. And it's all assumption driven. So
Yeah.
that's sometimes hard for people to kind of assume. But even if you're applying a multiple, you're just assuming that the status quo is going to continue. So
Hmm.
is that true or not? But yeah, for a lot of businesses, that's not. And so you have to really kind of model it out with those, especially with that volatility, like you're seeing with that business go from 10 to 15 million.
Yeah, I think it's Chris Schneider who says that every 90 days the owner should sit down and just ask the question, "Am I going to sell or not?" And I get what he's saying. Just kind of have the mentality, and if I'm not going to sell, what am I going to work on? But that starts with understanding what the company's worth today. If you don't know what's worth today, asking the question is just kind of it's just kind of cute and fun. And it's like, well, okay, yeah, am I going to sell or not? 90 days, am I going to sell or not? And understanding how you organize your company. And as you mentioned with the COVID stuff, you know, I don't know what industries are still wonky, what industries are back. I remember 2022 or 2023 talking to some companies, and some of the numbers I was seeing, like, man, this is wild. Like the ups or the downs is like, whoa, whoa,
Yeah.
whoa. And then by 23, late 23, 24, 25, it's like, okay, this seems to level off for a lot of people. And then of course you have the tariff stuff, which I think disrupted some, and you have stuff like that that comes into play. And um, I think I'm curious your thoughts on this. Sorry, I keep getting a cough. I think if the story makes sense, so let's just use tariffs. I don't have an opinion on the tariffs, just for this talking point. The tariffs impacted our business this way. People can go look up the tariffs, they can go verify the information, and they can check kind of the rough math on, okay, yeah, that seems to work. That's one thing. COVID, right? It impacted our business this way. Those are stories that can be told, and the buyer can go, yes, this math actually works with the story. It's going to impact your valuation, but it's at least a story that can be told. Sometimes owners want to talk about stories that really can't be proven, and I think that's kind of a discrepancy that I see a lot of times. Is, oh well, we had a good year because whatever it might be. It's like, well, or you had a bad year, but next year should be great. It's like, well, why'd you have a bad year? Oh, things were slow. It's like, well, I've talked to a lot of companies and they weren't slow, so why were you guys slow? And so how do you help owners maybe get their head around, okay, what is the story you're telling, and does this actually, is there a economic indicator or some kind of news story or something that ties this in and goes, oh yes, this actually does make sense?
Yeah, from my standpoint, I always ask owners, what's your, explain to me kind of what's going on in your mind over the last 5 years with your business, or however long we're kind of looking at, or the important timeframes. And then as an analyst, I go back through and contextualize all that, right? To say, all right, well, for this business versus that does the framing, right? They did really well, and their sort of numbers match what I saw, what industry peers were reporting, and what we saw economic data coming out. And so they were seeing the rise, and they were going with the rise, and then the fall, now they're going down with the fall as well. And so you can kind of highlight, okay, this is a pretty economic sensitive business. To tie that story back together. And I think what you're getting at is those disconnected stories that come together. As an analyst, when I hear those stories, I'll make my own subjective judgment, say, look, I get that you maybe put, sometimes clients will put the forecast together and say, hey, here's what we think is going to happen and blah, blah, blah. You go, that is really great. But a lot of times I'll discount that to say, look, yeah, you might think you're going to achieve whatever, but we'll have to assess it again versus what do we see sort of being forecast from industry reports? What do we see being forecast from other economic services that are out there to gauge the sensibility of that forecast? And then a lot of times we'll kind of discount that. I'll put a higher discount rate, say, yeah, it'd be great to achieve all that, but this is a higher, this is a lower probability event of happening. And we have to adjust the cash flows to say, yeah, you'd love to achieve X number in sort of revenue profitability, but you've never achieved that in the past. And we don't see you achieve, it's very hard to achieve that in the future. It doesn't mean you won't, but you've got to kind of discount that a little bit. I think people will miss that in terms of valuations. They'll say, oh, and maybe I'm getting a little too deep, but like we'll get to discount rates, but discount rates are based off the cash flow. So if you have a really sort of um, the one example I kind of like to give is like, Ryan, I'm going to give you $1 billion, right? Well, I'm not a billionaire. So you're going to say, I'm going to discount that to like, maybe Charlie's going to send me $10 in the mail. Warren Buffett calls you up and says, hey, Ryan, I'm going to give you $1 billion. You're like, oh, wow. Okay. I could probably start yacht shopping right now, because, there's probably a high likelihood you get it because he has the money, whatever. And so we have to do this kind of same thing with the business cash flows, right? Like the expectation might be we want to achieve something. As the analyst and as the appraiser that gets hired, I'm going to say either going to temper it or I might change it because I do get both sides of it as an evaluation person. In divorce cases, the in spouse or the spouse in the business, they want the value sometimes really, really low. The out spouse wants it really high. When we do M&A, the seller wants it really, really, really high. In gift and estate tax, the client wants it really, really low to be under the tax threshold. So we get that push and pull. And as the analyst, you got to come in and say, okay, what's the actual story here in terms of economic sense? And what do we think you guys think is going on? And then does that actually make sense? So, you do see it, and there's a lot of push and pull there. But you have to do your own industry research. You have to understand kind of where you kind of see trends happening. And once you kind of get that sense of it, I think you have a better idea of whether gauging people are actually telling the truth, or not telling the truth, but, giving a sensible take on that business.
Yeah. Well, everyone's got their perspective, depending on what's going on of what the business is worth, right? If it's a divorce, then and it's a highly contentious divorce, and yes, the spouses are going to really argue over that for sure.
Yeah, it's either the worst business ever that's been around and it's worth nothing, or it's it pays for everything and whatever. So you kind of see it all. It's funny.
Yeah. Okay, so I would say right now, in the business, education, whatever world you want to call this. And I'm not hating on someone like Hormozy, or I've got his books over here. I like Hormozy. But if you actually listen to what Hormozy says, he says, I don't care what you do. So I think he actually says that quite often, but people miss that. But a lot of the content is geared towards scale and growth, but very little content is geared towards value creation, getting a good number when you exit, understanding what that's worth. And if you look at the buy side, there's a ton of content out there. And I've been really trying to hammer this. And I'm not hating on like Cody Sanchez. I'm a free market capitalist. If owner financing is your jam and you want to buy a company for 100% owner financing and someone will do it, more power to you. Cool. I just don't think a lot of owners know that there's other options and there's better options for them. And so why do you think it is? Do you think that's true, A, that there's not enough education for owners on how to potentially maximize their value? And then why do you think it is that owners are hesitant to do it? Because I'm not anti-scale. I agree with Hormozy, do what you want to do. But I'm also a little bit hesitant to say everyone's going to have a $100 million company. The reality is most won't. But if you do a $5 million or a year revenue, or $15 million revenue, or $20 million revenue, understanding, okay, hey, getting in that spot, making that valuable, and then understanding what it would sell for, how much work it is to actually go to the next level. Because those multiples we talked about, as you go up, that kind of changes a little bit. And so understanding, okay, hey, if we're at a $5 million a year revenue company, we might be at the lower end, even if we peak, might be at the low end of that 3 to 7 multiple. But, if we get to 10 million, okay, but man, that's a lot of work. Or no, it's not. And so why do you think, do you agree that there's not enough education about that? And then why do you think it is that owners aren't really buying into this mentality, maybe in mass? I don't know. It seems like scaling is all the talk. Not anti-scaling, but this is where I think the real value creation is for companies.
Yeah. I think, one, there is not a lot of discussion on value creation. I think a lot of people don't really know what drives business value creation. Obviously, well, I wouldn't say don't know, but I think they distill it down to revenue for the most part. Obviously, revenue is the most important driver. Without revenue, you can't have profit, and you can't have pretty much everything else, right? So we all recognize that revenue is the most important. I think there gets to be a little too much focus. People think, I just need to get higher and higher and higher revenue, and people are going to pay more. Having valued hundreds and hundreds of businesses, the everybody wants cash flow. I don't care what kind of business you're buying. Everybody, especially in this small space, I'm not talking venture capitalists who want to just see like some sort of story or whatever. Um, you know, I think cash flow. So if you can drive that cash flow, I think a lot of people want growth. So they obviously, you can't really have growth and high cash flow at the same time. You either are growing, or you go high cash flow. But I think having a sensible and smart approach to saying, I want to grow revenue and we need to keep growing cash flow as well. And I think having that idea in mind of where do we want to go, like you're saying, like where's our actual objective? Because I think there is this idea like, yeah, it'd be fun to brag at a cocktail party that my business does $100 million in revenue. But you're right. Like, do you have the skill set to take it to $100 million when you're currently at 5? That is I think people don't want to admit the fact that sometimes the CEO of a $5 million business is different than the CEO of a $100 million business and of a $1 billion business. You see the Zuckerbergs or the Jensen Huang at NVIDIA, who can take it from zero to hundreds of billions of dollars. Not everyone has those capabilities. So I think owners have to be kind of real with themselves. Is that possible? Is your market possible to achieve that? It's a lot of businesses, the organic growth isn't there. So then is it acquisitions? And then do you have the capabilities to acquire companies at sensible prices and increase value? I mean, the most basic idea of value creation for a business is, are you earning a return over your cost of capital? Right. And that's companies who create value. The reason Apple was for a long time one of the most valuable companies in the world, not just because they created the iPhone, had this great product, their returns on their invested capital were like close to 90%. So, their cost of capital was like 10%, so they just were making so much money and had so much cash flow, they didn't know what to do with it. So the balance sheet grew, they gave it back to shareholders, started issuing a dividend. So it's things like that actually is what increases the value over time. And so I think a lot of people like to look at that headline number. That's why I love the phrase, what is it? Revenue's vanity, income is sanity, and cash flow and cash flow is reality. And so, that's it. I think, the value creation comes from the cash flow. If you're making a lot of cash, there's a lot that opens up the world of options to you. Can you go buy competitors? Can you, can you move into different verticals in your industry? It gives you all those abilities to then, control your destiny. And so sometimes what I see, to kind of wrap it up, is people pursue revenue and then take on debt or operate at a loss and then find out that the revenue they were pursuing did not actually turn into as accretive as they thought it was going to be. So
Yeah.
I think you got to be very careful about that.
Saw a company in Arizona. I won't say the name. I don't remember the name actually, but the Arizona company. And because I don't know the players, I won't say the industry, but they did about 90 to 100 million in revenue. They netted like $1 million.
Yeah.
And the partners were fighting. Guess the valuation was nowhere near $100 million.
Yeah. I was say, even if you're, that's,
it was like,
and that happens.
Yeah. And they were, they were fighting, and they wanted like $80 million, and they're going to split it. And they come in, I can't remember where the valuation came in at, but the guys were like maybe 15, like you got a bunch of revenue, right, but you're not making any money. You're not making any money. You're netting $1 million. Like, okay, on $100 million, it doesn't mean anything. I'm sorry. And it's not being disparaging. It's just, I'm sorry. It doesn't mean it's worth 80 million. And so to your point about revenue, you got to have it. But if that margin ain't right, it's going to crush you when you go to exit. And so, it was just depressing because it was $100 million. I remember $100 million company. They're fighting. I'm like, oh man, they're going to get a good, they're gonna split up and go their own ways, and it'd be great. And the net was like $1 million. I was like, what? Are y'all stealing from the company? What's going on here? How does this happen? And they explained it like, well, you got to pay the contractors this, and it's a really low margin. I'm like, guys, it's 1%. Like, what are you doing? 1% of your
I mean,
It's
you're working
so
really hard to make $1 million.
yes,
I mean, $1
yes,
million is yes a lot of money, but it's also not a lot of money. You start
yeah,
splitting that up, or if your revenues drop 10% or 20% one year because of a bad economy, like that might
yeah.
wipe out the entire profitability right there
It
for
was just
that
wild.
year.
Yeah, it was just
Yeah,
wild. And so, anyways, I don't think they ended up splitting up. I think they had to bring in some counselors or something because they realized that it wasn't nearly worth, They were like, well, what if we get 30? And I think there's some talks to PE groups, and they're like, no, like maybe 15 or something like that. And both partners got to stay on. Like it was not what they wanted. And so,
yeah. Yeah,
anyway,
I
so
think that's sort of the unknown. It's like the less spoken about truth. It's like really cash flow drives value. That's what drives value. So you want to
yeah,
hire value, get more cash flow.
yep.
Maybe that's more revenue. Maybe that's cutting costs. Maybe that's a mix of the both, or whatever it is. Just streamlining operations. There could be a lot there, but I think that's a key takeaway for most business owners.
Cash is king,
Yeah.
as the saying goes. So, also, you owe me $10, and Warren owes me $1 billion. So I'll just be whenever you
Right.
guys want to, whenever you guys want to Venmo me, it's open. I'm good.
Let me text Warren over here and
Yeah,
just make
text
sure he's still
Warren.
good for it.
Yeah, let him know. He can do tranches. We can do 100 million a day for 10 days. Whatever. I'm,
Right.
I'm fine.
You're flexible.
I'm flexible. Okay, so if people hear this and go, yeah, I do need a business valuation, where do they go to find out more?
Yeah, so you can go to my website, stantonvalue.com. You can also email, it's charlie@stantonvalue.com. I'm on Twitter at capital for the number 4 value. And so, yeah, if they want to do that, I'm happy. I don't charge for consultation to discuss about it. So free to chat and kind of go through what your needs are and what you think is going on and what you kind of want to hope to achieve. And we can work build a scope around what you want to get done. It's not just like a boilerplate. Hey, here's the valuation. Good luck. Have a nice day. It's a conversation. It's a tool that can be used to really help guide what you're planning on doing with your business and what you hope to achieve. Really achieve the goals you want to put in place.
Okay, well, good. Well, we'll link to all that. Thank you so much for your time today. This has been, I always love these conversations, and I always feel bad. It's not hating on owners. We're trying to say, owners, you're leaving money on the table.
Yeah,
The scale to the moon is great, but if you don't understand this, when you get there, you're going to find yourself just like those guys in that company I mentioned. Oh, wait, it's not worth a whole lot. And
yeah,
so you gotta understand what you're doing, right? It's because to build $100 million company is really impressive,
yeah,
really risky, really, to your point, like a lot's on the line there, and then to find out it's not worth hardly anything compared to what you want it to be is, that's depressing.
exactly.
That's really depressing.
And
So
you don't want to get to the deal table and finding that out.
yeah,
That's when you don't want to do that. You want to before you get to the deal table, you want to have a good number of what you're thinking or
yeah,
an idea of it at least. So, but thank you for having
awesome.
me. I really appreciate it. It's been great chatting with you.